Hi everyone, welcome to another honeystocks.com stock market outlook video, which will be going out on the weekend of the 7th of January 2023. Happy New Year everybody. It's been a wild few weeks. Of course, a lot has happened, as it always does. If you picked up our last analysis video, which was put out just before Christmas, and picked out some of the charts, I'm sure you've done very well. A lot of the charts played out exactly as expected. But before I switch over to my screen share and walk you through all of the charts and the data that I know many of you tune in for, I just want to take the opportunity to thank everybody for liking and sharing my work across social media. It really does mean a lot. This week I'm going to be going through a market deep dive. A lot of the charts from our chart books, which cover stocks, ETFs, commodities, bonds, will be covered. Just for disclosure, some of the charts that I will be walking through, some of our clients and myself may hold positions in some of those names. As most of you know, I do not use the magical hindsight indicator. I timestamp all of my work, which is incredibly important for the field in which I work. But although I use technical analysis, I'm definitely not a short-term day trader. There are plenty of gurus out there across social media and on YouTube that will happily steal your money. I'm looking for much bigger moves in the market, structural trends, primarily trend following, and my time horizon is generally weeks to months. But you'll find a lot of value from our work, I think. Everybody wants to know if the market is bottomed, so I will be giving some context this week around that. Some of our recent time-stamped calls called the market crash at the start of the year, the rotation from growth into value, the bear market rally in June, the exact top in August, the exact top in the US dollar, and the bottom of the recent bear market rally in October as well. And of course, more recent calls, the exact top in December, the bottom in bonds, and you can go all the way back to the crash of 2020 as well. I do have a track record of being mostly correct and getting the big calls at the big moments spot on, which again is very, very important for the field in which I work. And I've been encouraged by many professionals over the last few weeks to submit my work for Analyst of the Year, which is something that I'll be doing in due course. So if you do find some value from my work, please do like, share and subscribe on YouTube. There should be a little red button just at the bottom right hand of your screen, and also feel free to subscribe and share on Twitter as well. As Twitter says, I'm also a former Deloitte hostage, very data focused background, which of course helps to interpret the data for the field in which I work. But enough about me, let's dive into some charts, let's see what the market's telling us. As always, before I get into the charts, please pause the video, make sure you are comfortable with that very important disclaimer. Basically just says that there's not any investment advice and to do all your own due diligence. And of course, most of you know I am working my way towards my CMT, and technical analysis is something that I'm very widely known for in professional circles. But let me start off just spending 5 minutes just talking about the broader market, the directions that I think we are probably headed towards, and of course give a little bit of context around it. But I want to say straight off the bat, I understand the yield curve is inverted. I know that we are likely on the way to a recession. I know that stocks don't do too well during recessions, but at the moment there's a lot of positives that we can take from the broader market. Of course, the economy, etc. Completely get it. For all you economists out there, it's not looking too great. But I prefer to focus on the charts and the incoming data that price gives us. But this is the most important chart in finance at the moment. If you are not watching the US dollar index, it is the key to the direction of stocks as an asset class, especially of course US stocks. But the US dollar is in a recent downtrend. I did call the top a few months ago, and it has been steadily making its way lower. Now, this is a shorter term chart for the US dollar. The longer term chart shows a bigger picture. And I think if we break below these 2017 and 2020 highs, which is really the thesis that I'm working on at the moment, I think we see stocks absolutely rip higher. The reason I say that is if you have a look at the correlations, they're very strong correlation. It's been dollar up and stocks have been annihilated over the last 18 months, as we all know. But recently, when the US dollar topped, what's happened? Stocks have gone up. Now, of course, not all stocks have gone up. I think for those of you that maybe are into your tech names and the stocks that did well, 2 years ago, I'm sure it's still continued to be very, very difficult. But if you understand that it's a market of stocks and there are thousands of stocks to choose from, the S&P 500, for example, topped out in December. It is chopping about sideways at the moment, but there are plenty of stocks that are making new 6-month highs, and that's what I'm focused on at the moment. That's where the bulk of my work is focused on, and I have lots of those individual charts prepared this week for you. But the US dollar index is very, very important because there's a very strong correlation with volatility. If the US dollar index is continuing to move lower, then it's a reasonable expectation that volatility will continue to move lower also, which again will have a bullish catalyst for stocks. Now, the reason I'm not using the major averages, I guess, with the main bulk of my work at the moment, is because of the weightings that's heavily skewed towards big tech. I mean, if you look at something like the S&P 500, it's chopping about sideways, but we can see that if we equally weight the S&P 500, we are already 15% off the lows and 14% away from new all-time highs. Now, I understand that that's a big move for the equal weight S&P 500 to make, but if we understand that I guess the stock market is a vast ocean, and within that vast ocean you have lots of fish, and all you're doing is just picking out the easy fish. That's the way that I look at the markets. The bond market is continuing to tell us that stocks are potentially getting ready to move higher as well. There's been a very strong divergence. For those of you that have followed me over the years, you'll know that the divergences within the S&P 500 and the bond market, I look for these as a guide, and of course we are continuing to make higher lows, and of course we would hope that stocks will continue to follow. The bond market is of course massively important. I of course made the bottom call in bonds. This is a weekly chart, so it's a little bit longer term, but we are now starting to push towards its 40-week simple moving average, which we can see in the past has had significance. And of course, the 40-week moving average is very similar to the 200-day simple moving average. But my thesis at the moment is still that the bottom is in for bonds. It has been since the beginning of November, and the hope is that the bond market can continue to break out above these levels. Again, we're seeing the same thing with TLT. Again, this is one of our plays for our clients, but of course run straight into very basic support and resistance levels. But again, I think TLT is potentially gearing up for another retest of these levels around 108, 109. And I think if TLT can break out above that level, then of course that's going to be a further bullish catalyst. But to go back to my earlier point just a few moments ago about not really using the major averages too much at the moment, the Dow is of course an area of the market. A lot of value stocks within that we are very, very close, in my opinion, to just pushing on and retesting those all-time highs. Some of you may have seen a tweet that I put out just a short time ago, just basically asking the economists if they will go on the telly, the TV, and announce that they've been wrong on the stock market if the Dow hits all-time highs, because, as I said, there has been a very strong rotation from growth into value over the last 12 months, and that continues to play out. And I know for many of you that, like the tech names, the high PE ratios, the growthier areas of the market, I know it continues to be a challenge. Me personally, again, most of my work is focused on identifying uptrends in the market. I'm not looking to, double down on crap stocks. I don't think that's a strategy that really has a lot of merit. We've got the small caps to kind of go back to what I was saying. Lots of growthy stocks within the small cap realm. They are chopping sideways at the moment, so there's not really much that we can take from the Russell 2000. Our memo to our clients last week, just before Christmas as well, was, if the small caps are going to pull back, for those of you that like the ETFs, then perhaps this level around 163 might be a buy point there. But at the moment, we are in the middle of no man's land. There's not really a lot that we can take. And of course, big tech continues to get taken out to the woodshed. The Apples, the Amazons, the Googles, they've all just been getting flatlined, whilst again the value areas of the market over the last few weeks have been motoring higher. And again, I have some charts to back that up. But what would it take me to become bullish on technology stocks? Well, I think it starts with the 10-year Treasury note yield. We can see that it's been in a massive uptrend, which again has been a headwind for tech and for growth areas of the market. Very basic trend line here. I'm not rewriting the rules of technical analysis here, but it does look like we've broke down. We've come back and retested the trend line. I think if we break below these levels, then again, that could be a potential catalyst for a move into the tech areas of the market. This is something that I will, of course, keep an eye on and communicate to our clients and members. But, I feel that this is a chart worth sharing with social media, because we can see that there's a very strong inverse correlation between the 10-year note yield and, of course, technology stocks. So if the 10-year note goes down, it's reasonable to expect technology stocks to move higher. But I will continue to post this chart for as long as it's relevant. I have been communicating this chart, I feel like, every month for the last 12 months, just highlighting that there's been a massive rotation from from growth into value. But look what happened when we come out the dot-com bubble. There was an absolute rip in value stocks. That's currently what we're seeing across the board at the moment. Is it going to be a multi-year outperformance? I don't have the answer to that question. Of course, as the data comes in, I reserve the right to change my thesis on 30 seconds notice, but certainly this is a chart worth paying attention to. Ultimately, I do think that most of the market will move higher together if the dollar does collapse. But really, if you want to pick the best areas of the market at the moment, the chart is telling us that value is currently outperforming growth. Now, that leads me on nicely to some mega cap tech names and some technology focused names that I'm about to walk through. But if you are still here, it tells me that you're getting a lot of value from my work. It really would mean the world to me if you hit the like button. As I said at the start, you can subscribe. There should be a little red button if you're watching on mobile, on the bottom right hand of your screen. But again, feel free to like, share and subscribe. But let's get into some of the mega cap tech names. We know that they have not been doing too well, so I'm not going to labour the point too much. But not a week goes by that I don't get asked about Amazon, about Google, Apple, etc. But if you notice that the charts here, they are almost identical. So for me, it's very, very straightforward. We actually put Google to our clients last week, just highlighting 83 as a potential rebound level. It does look like it's holding up at the moment. Very similar with that, Amazon. So if you are in the camp that these are levels that you might want to potentially buy, you can look certainly at the risk to reward proposition between these levels. And the reason I like to highlight these levels is because they offer a very clear risk to reward and a very easy out if these stocks continue to move lower. Same thing with Apple. I have posted this chart to Twitter a few times, but below these levels, in my opinion, it doesn't make a lot of sense to own it. But if we can get back above these September and February levels, then again, that could be a potential bullish catalyst, especially for the major averages. I think the Apples, Amazon, Google, as I said at the start, that obviously big market cap weightings for the S&P 500. But if we break out above those levels, then again, the thesis of a rotation into tech would be completely valid. Big pullback recently in Nvidia. Again, I think it's potentially building a chart pattern there. Chart patterns, you might think it's junk science, and I get it. I'm not massive on chart patterns myself, but again, if you're looking for buy points with easy outs, then something like Nvidia might float your boat. We've got Netflix, which actually met our upside objectives just before Christmas, but again, I think we're potentially coiling up for another breakout there. So Netflix for me might get interesting above that 335, 340 level. Good old Tesla. Listen, it's been destroyed over the last few months. I get it. We reached a massively oversold reading. This is a chart that has been put to our clients just for full disclosure. It is an open high conviction alert that we have, and the hope is that this is the bottom for Tesla, at least for some kind of meaningful oversold bounce. I have a chart that I will be sharing at the end, just highlighting capitulation and what I specifically look for when I'm looking to take advantage of good stocks that have just been absolutely destroyed. But for me, Tesla makes a lot of sense. But it all starts with uptrends. These are the types of charts that I've been looking for. This has been covered for our clients for months now. YPF, $3.5 billion oil company, very low PE ratio, solid 12 months earnings growth. So massive uptrend. Let's see how far that one wants to go. Same with Crocs. I do not wear Crocs, but again, technical breakouts. Started covering this one back in November, and of course it's just been breakout after breakout. Again, low PE ratios. We've got ELF, again breaking out of a solid base. Again, we've been covering this one for months for our clients and members, but again, for those of you that maybe missed the initial entry down here in October, it could potentially be offering another entry. For those of you that like makeup companies, I think Simon Property Group makes a lot of sense above 123. Again, it's been in a massive uptrend, and the hope is that this is a very tight coiling of the spring. This is something that I actively look for when a chart starts to base within a very tight range. It's often an indication that it is gearing up for another breakout. Micron Technology, again, is in a massive range. We have an upside $65 target on Micron. This was put to our clients 2 weeks ago. We've got AMGN, again for disclosure, was put to our clients last week. has rebounded from logical technical levels. Again, I think there's reasonable PE ratios there. Massive $142 billion market cap company as well. We've got ExxonMobil, again, has been a little bit of a challenge for energy over the last few weeks. The oil markets, for example, have broken down below what I deem to be support levels, but ExxonMobil at the moment is holding up okay. We do have an upside objective there around 115. BHP, steel, again, I think there's a lot of upside there. You might have seen me post this chart to Twitter earlier on today. It's been doing great. We've got Verizon, again, massive breakout. Now, what I would say for those of you that maybe like Verizon as a company, buying it when the RSI is up at 77 doesn't tend to work out too well a lot of the time. Usually it's a case of just letting the trade come to you. Again, we put this to our clients last weekend, but I think a pullback opportunity probably makes more sense if you do like Verizon. I probably wouldn't go buying it way up there. We have KHC, again, is now approaching our second target there around 45. We've got the Bloomberg Commodity Index, for those of you that like to keep an eye on commodities. It does look like it's under a lot of pressure, the commodities space. We can see it with the DBC, it's in a tight range. And again, these are areas of the market that if we start to break below these levels, they could be short opportunities as well. The bulk of my work, I think, is predominantly about identifying trends, and usually it's uptrends. But recently, those of you that do follow me very, very closely will know that on Twitter I have been posting a lot of bearish charts over the last few weeks for stocks that I think could potentially go to zero. But shorting just to get it out there is part of my work as well. So I think if DBC breaks below those levels, then it could potentially be a valid short. But massive moves in the metals space, metals and mining. We've got silver miners, again, pushing up against potential targets there around 32. But, I am of the opinion that silver and gold probably goes a lot higher than what we're currently seeing at the moment. I think with gold, especially, we are starting to push up against breakout levels, and there are upside objectives there, especially with the GLD ETF. The gold miners have been unbelievable over the last month. I think there's a further breakout there. New 6-month relative highs to the S&P 500. So again, for those of you that do like the gold miners and understand that the gold miners move like growth tech stocks, they might float your boat. Barrick Gold is breaking out. Again, this is a recommendation to our clients. We've got Wheaton Precious Metals. I posted this chart to Twitter a few weeks ago. Again, it's absolutely ripping higher. And again, Newmont Corp, which was actually our play on the gold miners, again has been doing very, very well for our clients over the last month as well, and has actually offered a compound opportunity this week. We've also got the copper miners, again just inching its way towards our upside objectives there. But again, some of you will have noticed that I posted this chart to Twitter. Southern Copper met our target, but recording this just before the market close on Friday, it does look like it's breaking out again. We've got Freeport McMoran. Again, I think if that can break out above $44, given the upside potential for the copper miners, again, if Freeport McMoran can get above that $44 level, then that's going to be a big move in the offing, I think, again, for those copper miners. Stocks that we don't like around here, Coinbase has been a short of ours since it broke down below 40. Again, it's continuing to go out to the woodshed. GameStop, again, we're looking at massive PE ratios, horrific earnings growth. These stocks like this, I understand that they are meme stocks, the Reddit crew get on top of it, and you get the short squeezes, etc. But you just need to have a look at what's happened with, I think it's Bed Bath Beyond. I think that potential bankruptcy in the offing. Stocks like GameStop are absolutely in the same category. They could absolutely go to zero. So again, I think if you're below 1875, I think it's a short all day long. Some ETFs that you might find interesting. Again, as I said, the ARK ETF is below its COVID lows from March 2020. What I am very, very mindful of here, though, and this is something to maybe highlight for those of you that have stuck around here, is understanding the weightings of the ETFs and understanding that, if something like Tesla, for example, which we all know that Cathie Wood loves Tesla, most of us love Tesla, but if Tesla does rebound spectacularly, these types of charts can put in failed moves. With failed moves, we oftentimes get fast moves going in the opposite direction. So for me, the ARK Innovation ETF, whilst I don't have any time for any of the stocks within it, doesn't mean that you can't get some massive squeezes going on. So that this might be something to pay attention to. Again, same with consumer discretionary. But I did say that I would highlight what I look for with capitulation. If we look at the K-Web, the Chinese internet ETF, when we have peak negative sentiment, I guess, when we have these massive accelerated declines and we reach massively oversold conditions in RSI, I'm just looking for this big candle wick. As soon as we get this candle wick in, it really tells me that buyers are stepping in, and to just jump on board and have a process that will take you to as far as the trend wants to run. Now, hindsight tells us, of course, K-Web has rallied 99% from my call on the 24th of October. But if you go and have a look at this chart and maybe compare it to Tesla, you can see some kind of similarities there. So that's something that I would just encourage everybody to be mindful of. Technical analysis isn't this, tool that lets us see the future, but what it does tell us is that there are opportunities, and that's something that I'm seeing, I think, with Tesla, and something that you might want to take forward with you. But again, K-Web is potentially looking to break out along with emerging markets. Again, failed move watch. I'm looking at the clean energy space. I think if clean energy can get back up above that $40 level, then you're probably going to see some almighty squeezes in a lot of the names that are associated with the ETF. And again, we've got the First Cloud Computing ETF. Now, we put this to our clients last week. Was anticipating a breakdown today, but ultimately what's happened is that there's just been a flurry of buying. So the expectation is that the Sky ETF can maybe catch some kind of bid there, and if it does, then there is probably some kind of risk to reward there for those of you that prefer ETFs over the individual stocks. Now, I hope that you've found some value and some insight from my presentation today. If you have just stumbled across my work, feel free to stick around for a minute, but please do hit the like, subscribe and share on social media. It would be much appreciated. But if you have just stumbled across my work, feel free to go and check out our website at honeystocks.com. We provide professional technical charting research to professionals, retail, financial advisors, etc. But with our memberships, we provide our premium weekend work, all of our premium charts, all of our high conviction investment ideas, which I log on our website. I also provide access to our midweek halftime report, access to our investment community. If you are somebody that's maybe quite new to the markets, I also provide access to our technical analysis program. But I think everybody really wants access to my chart books. And if you want access to our ETFs, our commodities, and our stocks chart books, we provide it all within all of our membership options. But just to show you what our ideas look like, this is an idea that went out for the commodity index, which was a short last year. Netflix, which was a massive winner. Energy space, ConocoPhillips, massive winner. ELF, which I think I covered in the presentation, again was a massive winner and continues to be a massive winner. We've got ExxonMobil, again good winner, and Steel Dynamics, good winner as well. So feel free to go and, as I said, check out our website. I have logged every single investment idea, high conviction idea that on our website for complete transparency. There's also a link to all of our big timestamp market calls, but feel free to go and scrutinise that and see if the types of stocks are the types of stocks that you like to buy. Yeah, if you are still here, thank you very, very much for watching, and perhaps we can welcome you to our community soon. Thanks as always.